Good afternoon, everyone. It's Maureen Lutkins with Underwriters Marketing Service, and very happy to have you with us. A couple of housekeeping items before we get started. This session is intended for insurance professionals and advisors only, not for consumers. We are recording the session, which will be available to you at the end. However, all of your lines are muted. If you wish, this would be the time for you to exit the program if you do not wish to be part of a recorded session. On the right-hand side, in the chat or in the question boxes, is where you should type your questions, and I will field as many of them as I can for our speaker. I am happy to introduce you to Kathleen Johnson, Regional Vice President for Mutual Trust, and interestingly enough, providing you with what we all started with probably, Whole Life 101. And it's really time to get back to that and remember what we had with Whole Life. Kathleen has worked with Mutual Trust for 24 years, and what's pretty good about her career is that she started in new business and service and commission, and now she's of course a major part of the sales team. So it's really nice to have someone who has seen all of the transfers of business and premium and et cetera, and could probably help us along the way. She just recently completed her CLU, and like one of our staff members, she has 6 children, not to mention a 4-footed friend named Belle. Kathleen, it gives us great pleasure to have you with us. It's all yours.
Well, thank you very much, Maureen. I appreciate all of you that are joining us today. I'm not completely crazy. 3 of the children are biological and 3 are stepchildren. So it makes kind of a Brady Bunch situation at our house for any holidays, yours and mine, but not ours. But yeah, it's a fun experience, and really I've lived that entire life through working at Mutual Trust and the family that I have here. It's a great company to work for, and I'm really grateful that I'm going to take this time, have the ability to do so with you guys, and maybe go back to our roots, as Maureen was mentioning, to where we all began at Whole Life, and make sure that we're up to date with all the options and offerings. And let's get started. So before we get too far into Whole Life, I want to very quickly go over the life insurance spectrum. And so let's begin with talking about term insurance. Term insurance, most of you will already know this, a level premium for a set time frame, and then typically that premium increases. In some cases, the term drops and it just expires in total. Generally, there's no cash value. There are some terms way back in the day that earned a dividend. Those are very far and few between, and probably not on the market anymore that I'm aware of, at least. There's also the guaranteed universal life. These are guaranteed level premiums for the life of the client, and it may have some guaranteed, some non-guaranteed cash value, but typically that is for a shorter period of time. It kind of comes and goes. And for the majority of the policy's life, you're not going to see any growth within that policy. It's really just a term policy with a level premium for the policy life. We also have a traditional UL. This is going to be a flexible, non-guaranteed premium. The client can make adjustments to their premium as they see needed. There's definitely potential for some non-guaranteed cash value, but usually a very small amount of guaranteed cash value. Now, most of you are probably also familiar with the indexed universal life. There's not a cute little block for that, but very similar to the universal life, except for that the potential non-guaranteed cash value typically has a much higher, a little bit more favorable non-guaranteed availability of growth there, but options for you nonetheless. And then finally, we get to the star of our show today, our Whole Life, with, of course, guaranteed premiums. And that word guaranteed, you're going to hear me say a lot. So if you have $1 for the dollar jar, you're going to be able to go on vacation at the end of this presentation if you put $1 every time you hear me say the word guaranteed. But there's also cash value growth, again, at a guaranteed rate. And then also there's a potential for dividends. Now, unlike our friends in the universal life world, where it's mostly non-guaranteed and a little bit guaranteed, whole life is really the polar opposite, where it's mostly guaranteed and a little bit of non-guaranteed. And the only non-guaranteed item in whole life is the dividend. So everything else is contractual. You'll see it in the policy pages. You know, growth year after year. If premium is paid, then this is how much it's going to grow and all that good stuff in both cash value and in death benefit. So let's get into it a little bit more. Whole life has really four major aspects: the guarantees, there's another $1 for your jar, premium flexibility, the living benefits, and also those dividends. With guarantees, you're going to have guaranteed premium, guaranteed death benefit, the growth is guaranteed in the cash value aspect, and the access to that cash value is also guaranteed, which is also kind of a neat idea to think of. It's not just what the product can be, but how you can utilize it is guaranteed. And then also those non-forfeiture options, which essentially means if I can't pay my premium, what happens to the policy? And this is a really important aspect to think of when you're thinking against some of those other products we talked about, the term and the guaranteed UL. Because on either of those products, if life changes, and I think we can all agree that life changes, they don't give you any wiggle room or any flexibility to make adjustments to your design or your cash flow as it pertains to the policy. With whole life, having non-forfeiture options, ways to help the policy if the client can't pay the premium, it has those kind of, I'm going to call them exit strategies. It has ways to adjust for life happening. And that's really an important guarantee that we'll get into a little bit in more depth shortly. There's also premium flexibility, premiums from policy values, and you're going to see all the acronyms here because we are an insurance company and we love our acronyms. So premiums from policy values is essentially a surrender of cash value to pay the premium that's due. You have an extended term insurance, or ETI, which is taking the cash value that the policy might have accrued and buying the same amount of insurance that you had previous with the premium paying side, and then it will use the cash value to pay that amount of term until it runs out of cash value. You also have a reduced paid up option, and this is to take the cash value and essentially buy a single premium death benefit that's paid in full based upon your client's current attained age and the risk class that they were in when the policy was taken out. And the final premium flexibility that we have listed here is the automatic premium load or premium payment. And these are if I skipped my premium, I missed it, I moved, I forgot to change the address, whatever the case might be. Maybe a pandemic hit and I didn't have the money to pay it right now. The policy would use its cash value to take a loan to pay the premium that's due. And that's different from the PPV option we talked about first, because that would be a surrender, where the last option is a loan. Now, any of these premium flexibility options that I've rattled off to you, and don't feel like you need to be an expert, it's okay. We can always talk to you about those options as the need arises. But these are all those kind of what I'm going to refer to as an exit strategy. If I can't pay my premium, what am I supposed to do? I have options, and here are 4 of them that you automatically can utilize on a contract. The living benefits is also a very important one. Accelerated death benefit rider. We're going to get into all 3 of these in a moment as well. But the accelerated death benefit rider allows you to access death benefit while still living. The liquidity, access, and control of your policy's cash value, again, through policy loan or even withdrawal. And the customizable and flexible riders. So whole life by itself, I think, has a reputation of being kind of structured and rigid. Paired with these different riders we have, we can really make endless possibilities of policy designs and what can work for your client. So as a quick MTL break, just wanted to make sure that I share, if you have a client that you're not sure of and they're looking for something that's a little bit less risk adverse of some of the other options we talked about, and a safety product like whole life with all these guarantees and it might be a fit, please make sure that you contact UMS and our sales team so we can help you design a product that's best suited because we really do have a lot of flexibility here. And then finally, a dividend. And as you might be aware, the dividends are truly a return of premium. We're taking your premiums in, we're investing them, depending on how the product is priced and what the mortality is expected in that experience. We can hopefully return some of that premium to you. Obviously, if there's more mortality and more expense than we expected or a lesser investment earnings, we might have to adjust that dividend. So the dividend is the only aspect of our whole life, once again, that is not guaranteed. And I'm saying that because I want to make sure that when you're looking at an illustration and you're looking at the guaranteed aspect of it, and then the dividend side is not that much different, it's because we don't, at Mutual Trust, we don't focus on the dividends as much as the guarantees. If you're going to end up with $100 in any way, would you rather have $50 of it guaranteed and 50 not, or 70 of it guaranteed and 30 not? So when you're comparing dividends, you might see a big variety from company to company of what the dividend payout is, but the overall total cash value is really what we want to focus on, and especially the guaranteed aspect, because no matter what the economy does, no matter what interest rates do, your cash value will be at that rate that you promised your client, and you'll never have those uncomfortable conversations about sorry, we talked about this, but XYZ that was outside of our control happened, and now your program is not going to look the same. So again, that's why we really focus on guarantees with the whole life products. And as a little special note I almost forgot about, Mutual Trust has paid dividends for over 110 consecutive years. We're almost at 120, but not quite. So if you hear me doing this again in 2 years, you'll see that number has updated. But for convenience, we leave it as it is, update every 10 years. So let's talk about those dividends and the options that you have available. I'll rattle through a couple of these a little bit more quickly, that they're a little less prominent in the world of whole life, but they all are options. You accumulate with interest, which essentially works like a savings account. You can use it to reduce your premium as it is earned. It would reduce the premium due. You could receive it in cash, and we would send a check out for the amount of dividend each and every year. The most common across the industry would be paid up additions. You earn a dividend. It buys a paid in full single premium death benefit at your client's attained age, and then it gives that death benefit, gives them cash value. There's a slight charge to have the death benefit in play, but that death benefit then earns a dividend the following year. So it's really a kind of a Lego building block that you're starting, and you're making sure that that dividend that has purchased the death benefit will always be in play. Once the dividend is earned, it will never go away. And that is true statement of all of the dividend options. It's not something that's in the non-guaranteed mix once it's applied to the policy. So dividends are non-guaranteed until they're applied, and then they become guaranteed at that point forward. So the fifth option is to reduce loan. The sixth option is to purchase 1-year term insurance. And then seventh, you can really utilize all of them. If I wanted to do a reduced premium and my dividend is larger than my premium, I can have a secondary dividend to use the rest as a paid up addition. Or maybe I had paid up additions and now my client is unfortunately terminal. I might want to change my dividend option to buy 1-year term insurance to increase the amount of overall death benefit that would be transferred to their heirs upon that client's death. There are different options. You're not stuck to one of them for the policy life. They can be adjusted. So just know that there's a lot of options out there, and Mutual Trust actually has one called a maximum accumulation dividend that is patented and only ours. So I'm not talking about it here, but essentially it helps build cash value without causing it to become a MEC. Lots of options. Let's not get too far in the weeds here, but I wanted to make sure you knew what those options for you were. So the living benefits. There are really 3 different tiers that we talked about: the accelerated death benefit, the liquidity, access, and control, and also the customizable and flexible riders. So let's talk about the accelerated death benefit rider first. Accelerated death benefit has a lot of different options. Terminal and chronic illness provision is what Mutual Trust offers, and at no premium to you at all. There are some companies that also have a critical illness, which is something we're looking into now. And there are also some that have like a long-term care, but you would pay for those. It's a premium paying rider. So keeping everything free of premium for your client and automatically added for anybody who qualifies, meaning that you're a table 4 or better, you're under age 75, or your death benefit is 50,000 or above. The accelerated death benefit with both terminal and chronic illness will automatically be applied to your policy, unless, of course, you live in California, then they have not approved chronic illness. One and only state that's holding out on us. But the important thing to know here is that if something happened on the terminal side, you have 12 months or less projected to live, you can access up to 50% of your death benefit or $250,000 while still living. And you do not have to be, it's not like a long-term care in the fact that you could take that money out and you can have a trip around the world or go to Disneyland. You can also use it for in-home care or needs that you have that you want to meet while still living. There's not a like a licensed facility or a licensed caregiver that you need to have and have that expense and have it reimbursed, nothing like that. So it makes it really easy to deal with, you know, if you choose to accelerate the death benefit. The chronic illness is you qualify for if you cannot function in 2 of the 6 activities of daily living or have a cognitive impairment. And in this case, you would be able to take up to 24% of your overall permanent insurance. So if you have term insurance, chronic illness is not available to you at the current. And at that point, there would be a fee to access that death benefit early. And that just depends on how much the fee would be, how much that expense would be, is how far away you are from your pay up, your natural pay up year. So on one of our more prominent products, the pay up year is age 90. If you are 80 when you're accelerating your death benefit, it's going to be a very small fee. If you are 20 when you accelerate the death benefit, you'll see a bigger adjustment to the overall death benefit because there's a longer period before you get to the pay up year. But that's an option you can choose to elect at that time or not. Cash value is always still accessible to you as well, which brings me to the second option. You always have cash value in a whole life product without any riders beginning in year 2, with riders immediately, depending on which riders we're talking about. And we'll get to that in a moment. But the liquidity, access, and control that Mutual Trust provides with our policies is really bar none to most other companies in the industry. And we do that through policy loans and allowing you to take a loan in the very first policy year. Any cash value your policy has accumulated, you have access to that. And I'm saying first year, but the honest truth is really 10 days after the policy has been issued. And we only make you wait 10 days because we want to make sure that initial premium check clears the bank. Everything's on the up and up before we start loading out money, of course, trying to avoid any fraudulent behavior. The loan processing is very quick. It's easy. We have a 5-day turnaround from the day we receive your request to the day that we send it out, whether it be check or EFT. And then it's 100% of the cash value that is accessible to your client, less the loan interest charge that we would take out up front. And our loan interest from the majority of our products right now is 3.85%, which is lower than the majority of the industry currently as well. Just goes to kind of prove how much we really embrace the idea of utilizing your policy's cash value for life. And then finally, though it's not required, we do recommend that you have your clients repay their policy loans. And we recommend that simply so they can have the full benefit of the policy and you can kind of reutilize it, recycle the cash value over and over and over again. And we make this super easy because you can make one policy loan repayment on the first day of the year, the last day of the year, one loan repayment every day of the year, though that would be tedious for both you and us. We'll accept it. Or the most common way is simply to do a bank deduction on a monthly basis of the amount that you choose in the day of the month that you choose. You complete a form that's very similar to the EFT form that you would use to have us draft for premium. We would do a secondary draft for the loan repayment. And you can turn that on and off, adjust the amounts that are being deducted as whatever it is that makes your client comfortable. So it's a very simple process and very easy to use. And lastly, of our living benefits is the riders, the customization and flexibility. So we were talking a little bit about acronyms, and you're going to see a bunch on this slide. But let's get started with PUA riders, or paid up additions. You might also hear some companies call it a paid up insurance rider. They're the same thing, paid up additional insurance, paid up insurance. It's simply in essence, a single premium product that we're putting on the side of your whole life product, and you can continue building on top of that in single premium manner. Very similar to our paid up additions dividend we talked about earlier, but instead of having your dividend purchase it, this will be a premium paying rider. Now, the major difference between the single and the flexible premium PUA rider is one is single and one's not. And I don't mean that they're looking for a date for Friday night. I mean that you put one premium into it and it's a once and done. That rider, the single premium, is typically used for 1035 exchanges from another contract into ours, or for someone that has a big buildup of money that they are housing and you're redirecting for them one time. It's not going to be something that's going to be like an annual bonus that's going to continue coming in, or things like that. And for those cases, it's more of an annual thing or biannual. You would want to use the flexible premium paid up additions rider. Now, the flexible rider at Mutual Trust, and this kind of the nitty gritty here changes from company to company, but we've made it pretty easy for you. The minimum you have to pay per year to keep this rider available to use is $100 per month, and the maximum is guideline $100,000 per year. But that we can talk about that if you have a client that has a greater need. So typically that $100,000 is going to be reduced to keep the policy as a non-MEC or a non-modified endowment contract, and make sure that we are in line with the IRS guidelines to what they say a MEC is and what the tax preference would be. So thinking about a non-MEC, we would issue you saying, let's pretend $15,000 can go into that flex rider. You pay $100 initially, you pay $100 in year 2, you pay $100 in year 3. And then in year 4, hey, I got this big lump sum I expected last year, but I didn't get it. Put that 15 grand in. It's buying additional paid up death benefit. It's giving you cash value immediately. Normally about 94% of the premium that goes into these single or flex rider will be available to you in cash value right away. And then you can continue building that next year and kind of repeat. Now that we have the 10 and the 20-year term riders available, and typically those are added to a whole life policy for one of two reasons. I have a whole life policy, I need X amount of death benefit, but I can't afford it all right now. I'll put some of it in whole life and some of it on a term rider, and then convert my term rider later down the road when my cash flow is a little bit better than what it is today. Or maybe I even take off the term rider after a certain period when my kids are done with college or my house is paid off. But it's just a way to kind of help you have a blended whole life and term product all in one. The second reason you would use this term rider is typically, we talked about the IRS and the guidelines that they require. We can add a term rider to meet the IRS death benefit guidelines while allowing your client to put more of their premium into the paid up additions rider, which again will give you about 94% in cash value of the premium that goes into those riders. So we're meeting the IRS guideline, allowing our clients to have a lot of cash value up front, and then we also have the extra death benefit, even though a secondary need, a need nonetheless, that would be income tax free to our beneficiaries. But what if something happens and I become disabled? Well, we have solutions for that too. The waiver of premium, we offer a 2-year or a 5-year own occupation rider. You choose whether you want the client to have the 2-year or 5-year own occupation waiver of premium. And what that essentially means is that if you become disabled, and not at the time the app was taken, but at the time of my disability, can I function in my current job, my current occupation? Yes or no? That is really the qualification needed to qualify for the waiver of premium, for us to waive the premiums due on the required aspect of your policy. I say required aspect because the disability benefit rider, shown right below, does that exact same thing, either the 2 or the 5-year own occupation, and then it will pay for the flexible premium paid up additions rider. So in the example earlier, you had only paid $100 into my flexible premium paid up additions rider, and then I became disabled. We would still pay the full $15,000 into that rider, giving your client cash value that they could utilize while disabled or leave there to continue growing. Choice is up to them, but with the disability benefit rider, we would be paying the premiums for them, allowing them to have that huge increase in cash value for them. So what happens after 2 or 5 years, you might ask? Well, that's when it becomes an industry standard waiver of premium, where based upon your education and experience, we would say, do you still qualify for this premium being waived or paid for you? And in a quick example, if I was a surgeon, I can no longer perform surgery for the first 2 or the first 5 years. That would be enough to have my premiums waived. After the 2 or 5 years, I still can't perform surgery, but I can now be a physician or maybe a teacher of surgery. I just can't do it myself. Well, in that case, I would no longer be eligible for waiver of premium. And again, that's industry standard. We wouldn't ask a surgeon to now be a fry cook. It has to be something that's within that wheelhouse of their education and experience. But a really great waiver to make sure you add on or at least talk to your clients about, because as we discussed before, life is going to change and hopefully we don't have to deal with disability, but whatever your concept is that you're selling the clients with, making sure they're protected for disability is a pretty major one. Now, finally, just a couple seconds on each of these. Other riders we have available is our accidental death. If you were to be killed in an accident, additional death benefit would be paid out. The children's insurance rider, allowing all of your children that are born or naturally born or legally adopted to you, can be covered up to $10,000 on this rider, and each of those children have the option to convert up to $50,000 going forward. And then the guaranteed purchase option, you might be familiar with a guaranteed insurance option, very similar. This is really purchasing a rider that ensures your insurability. So it's not giving you coverage today, but it's giving you the option to buy more coverage in the future based upon today's insurability factors. So if I am a standard non-tobacco today and tomorrow I decide to start smoking 3 packs a day, if I had the guaranteed purchase option, I would still be standard non-tobacco going forward. So it's just saving my insurability, and it's a very important rider for families that have a little more uneasiness about disability that's maybe happened in their own lives, and they want to make sure that their children can get insurance in the future. So they might add this guaranteed purchase option on now to ensure that they can be insured going forward. All right, so one thing that Mutual Trust often will send out, and we want to make sure that you're aware of, is that we go to our agents and ask them what we need. So we design our life insurance spectrum specifically with you in mind and what you've told us that your clients need. So our spectrum starts with temporary coverage, that's our term insurance, permanent coverage on a budget, permanent coverage with more of a cash value focus, and also a legacy wealth transfer. I'll go through these quick because I know we're running low on time. We do offer a 10, 15, 20, and 30-year term. You understand term most likely, so I'm not going to go into too much depth here, but we do have conversion options to whole life. And when you're purchasing a term for your client, just make sure that it's a company that has a good whole life to convert to and that the company has good conversion options. Because if God forbid something happens where they no longer can be insurable and that term runs out, you've unfortunately put them in kind of a pickle where they're not able to be insured anymore. So make sure you have a good term company with a good whole life to convert to and good conversion options. Our permanent coverage on a budget is really a low cost, low cash value accumulation focused product. And it's really focusing just on the death benefit. It's what I would call the first step into whole life. So you're going to give this to someone that's really looking for a death benefit is a main factor, but with the cash accumulation, it still gives you those exit strategies we talked about before and the change of life options. Now, our kind of bread and butter, our flagship products is this falling into this field here, the permanent coverage with a cash value focus. And for examples, it works for anyone, but the main examples here, clients that are 45 or younger wanting to reposition funds for long-term growth. It also is really great for older clients that are looking for a way to, what's the words I'm looking for? Use like the infinite banking concept, or use their cash value for an alternative way to fund things in life. In either case, it's tax-free access through those policy loans we talked about. You have a guaranteed death benefit for your loved ones. And we also have the last product, which is our legacy wealth transfer. And this is for someone that is really just looking to have money for rainy day, just in case I'm not expecting to use it. So it would not be your traditional annuity client that says, I need this as my income for retirement. This is for someone that says, I've earmarked this for my family, but I don't want to give it to them now in case I need it. So a legacy wealth transfer using our Horizon Legacy product is a great way to do that, income tax free. It still allows them to have access to that cash if they need it, but it's not the intention of what they have set the money away for. Typically, you're going to find this in something a little bit more like a CD or a savings account than you will in any kind of an investment. And that was my very fast talking version of our Whole Life 101. I hope that you were able to get a lot out of it. I don't know if anyone has any questions that I would be happy to answer at this time, if there are any.
We do, Kathleen. We have one that I think you can answer quickly, and then a second one that is even more interesting, really. It's the first question simply says, if you take a loan, this is someone who's, trying to learn and really capture the essence of whole life. If you take a loan, doesn't the face amount of the policy drop? And if it's paid back, does it go back up?
Yes, the cash value and the death benefit would be reduced by the amount of the loan that's outstanding. And as you're making loan repayments, it doesn't have to be repaid in full, but as you're making loan repayments, you're recapturing that portion of cash value and death benefit. Because in the reality of what a policy loan is the policy owner is taking a loan from the life insurance company themselves, and then we as a company are kind of putting a lien against your policy for that amount. And as you make repayments, we release that portion of the lien to allow you to kind of continue recycling that and use it again.
Thank you. This was a little more interesting, and I suppose you could do a whole session on it. Not that we want you to do that now specifically, but what kind of flexibility and in what ways can whole life provide and design? I mean, there's so many options, are there not?
So yes, and that's one of the things I mentioned early on, is that I think I just want to make sure that everyone on this call and anyone who might listen to it later is aware of the flexibility that whole life can provide. And the design is going to be completely up to what your client's goals are. So you let us know the details of the client and the money they have available, but tell us mostly what their goals are, and we'll be sure to help design that product to look, or the policy, excuse me, and using the right products and all that good stuff to give them exactly what they're looking for. If it's a wealth transfer, if it's something to be utilizing for more of a banking concept, if it's simply just that I want some insurance with some flexibility to shelter more funds away so that the FAFSA forms while my kids go to college aren't reportable because life insurance isn't. We have lots of different ways to meet the needs depending on what those goals and needs really are.
And do you typically encourage young people, really young, like sometimes we hear about the grandparents buying for the grandchildren a whole life, and maybe it is or it isn't for college, but do you encourage that type of business to come in? And if so, I mean, do you go down to 0 or 1-year-olds?
We do insure up to a child that is 15 days old is the youngest. There are companies that are primarily focused on child insurance. Though we can do it, I wouldn't recommend us for that type of a sale And the reason I say that is not because I want you to look elsewhere, but in my experience, if grandma or parent is looking to put something on baby Susie, what is really the financial loss if baby Susie something happens to them, and what's the likelihood of that happening? It's much less than on the parent or on the grandparent. So what I would highly suggest, instead of looking at the child, which I know we're pre-programmed to say, but the mortality is so much lower, it's going to be so much cheaper. There are a lot more restrictions with the child, because for many different reasons I won't get into today, but we can talk about this offline for whomever had the question. So I would suggest to always ensure the parent, even if grandma or grandpa are paying for it, and then you can have the child as the beneficiary. If for some reason that parent prematurely deceases, dies, whatever the right way to say that would be, the child's getting the death benefit and you're still helping them. If they don't, the parent or grandparent can always transfer the ownership to the child once they're older, or continue having control over the cash value and loan it out to the client or to the baby once they're older for their needs. So either way, I would strongly suggest kind of rethinking about who you're really needing to insure, who you're really wanting to protect, and encourage you to do that on the parent versus the child.
I appreciate your covering that, because we frequently do have that, that asked. Okay, I have another question, if you don't mind.
Sure.
Do you market any non-participating policies, or are they all dividend eligible?
All of our whole life products are participating, meaning that they earn it or can earn a dividend. There are some companies that have both. Right now, our portfolio has all participating and has the 24 years I've worked here, but that's not to say that there may not be a point in the future we might have some product for some uses that don't, but currently they're all participating.
Thank you. Another question, Kathleen. Do you have something utilized in the process called wash loans? We frequently hear that in the industry at IUL, wash loans.
So currently we don't have a wash loan. I do know what a wash loan is. It is something that we're looking into seeing if it makes sense on a whole life product or our whole life product to be able to offer. But what I can tell you right now is the products are earning guaranteed either 3 or 3.75% depending on the product. There's a dividend that's earned on top of that, and our loan interest rate is 3.85. So is it a wash loan? No. But are you really experiencing much different than that? Also no.
Okay, very good. I presume there are so many opportunities here to do little, even 15-minute reviews on how to handle something for a child and handle something for
Sure.
an older person interested in a child. And I would like to suggest that we continue learning about that. I know particularly I'm interested as well. I do have one final question though.
Okay.
How do you figure out, I guess it's commission oriented, how we get paid?
Yes, and I don't know if the majority of the folks here are annuity or UL selling folks, but there's two different aspects of how you get commission. The base policy, or what I'm going to call required premiums, base term riders, waiver of premium, any of those excess riders that we talked about at one level. And when you get your contract with UMS, they're going to say you're at X percentage level of commission. That's the percentage you're getting paid on all of that premium. It's a reduced commission for the paid up additions riders. And really, it's a good way to think about it, is the things that the mutual trust or the whole life company in general is giving your clients access to immediately, you're going to get paid less commission on it. Where the base policy, the term riders, all that don't give the cash value to the clients early on, you're going to get the much higher commission level on that. So there's two aspects. Our commission statements will break them down for you, but if you ever have any questions, I'm happy to help you, as well as I'm sure the UMS team can assist with that as well.
Okay, I think that's it, Kathleen. So,
okay.
Unless there's something else you would like to add, I want to thank everyone for joining us. And I am looking forward to scheduling a few more sessions, little snippets of how to design, especially whole life plans, because they are so different than even the IULs are a little bit Simple, in
Absolutely.
my opinion. So, again, any final thoughts, Kathleen?
That's all the things that I can, throw at you in this one period of time, but I'd be happy to come back and share any more that I know. And I really do appreciate both the agents that have joined us today and UMS for the time. It's great working with you guys, and I'm hopeful to be able to work with you even more in the near future.
Thank you. Thank you to everyone who joined us today. Take care now.